I can expect meaningful margin expansion over time just with scale.
I will apologize in advance, but I don't agree. Scale doesn't matter. Hard work gets you there. Too many people are taking too much money, raising too much money too early. And if you raise too much money, you make expensive mistakes. If you don't have a lot of money, you make cheap mistakes. The situation that gets an entrepreneur to 25 or 50 million at exit is very rare. A bunch of others that have sold for $500 million or $1 billion or $2 billion. And, those are the aberrations.
All right, ladies and gentlemen, welcome back to another episode of Making Sense. Today, I have with me Andy Whitman, a managing partner at Loft Growth Partners, which is an earlier stage consumer fund. And Andy's somebody that I met. We were just trying to put it together. I don't know, probably 4 or 5 years ago. We haven't talked in a while, so I was excited when he obliged and agreed to come on the pod. And we're going to break down a lot today, and particularly with regards to sort of early stage venture capital. When does it make sense for brands? When doesn't it make sense? We're gonna get unpack a lot here. So Andy, welcome to the program. Thank you for joining us.
Well, thanks for having me. Good to see you.
Great. So why don't we just start with your background? Like, tell us a little bit about where you started in the industry and how you ended up kind of in the investor seat.
Sure. I'm not a typical investor if there is a profile. I started as a CPG operator. I started at what used to be General Foods. General Foods was a Dow 30 stock. Bought Kraft, was smart enough to say Kraft is probably a better name for the combined entity than General Foods. And over time also bought Oscar Mayer and Nabisco and Cadbury and a whole bunch of other businesses. And today that operates half as Kraft Heinz and half as Mondelez. Anyway, yeah, so I was privileged enough to be in an amazing group at General Foods, learning from some great people. And I had some very traditional sort of big company marketing, sort of business leadership roles, but also some funky sort of non-traditional roles. And across some of those non-traditional roles, some sales roles, an operations-ish role, some business development and financial roles, I got a chance to meet a bunch of the private equity firms that were really marquee in the industry. And,
Which is like who at that time?
At that time, there were 3 sort of super marquee consumer funds. And remember, this is in the 90s. Catterton still exists as L. Catterton. The Shansby Group, which is now TSG Consumer Partners. When Gary Shansby retired, they just simplified the name. And Swander Pace. And a huge number of the terrific funds, and those 3 are great, but a whole lot of the others came out of those 3. Encore, VMG, Prelude, lots of others. Really good funds. Really good people, too.
Like it's like a Tiger Cubs of CPG. That's kind of...
It is. So I had 2 observations by around the year 2000. Some on the sort of multinational CPG side and some on the financial investor side. But what was common about both of them is they needed a farm system, if you want to use a baseball analogy. The multinational Kraft, P&G, Cokes, L'Oreals of the world were good at thousands of things, but what was common about most of them was 2 big things. Not a lot of patience, which comes with mostly being a public company, and really good at 100 million to $1 billion, but not great at 0 to 100 million. All right. So that was the multinational side. And then on the private equity side, even though their funds were teeny by comparison with their monster funds today, they still couldn't write a 2 or a 5 or even a $10 million check back then. So nobody was helping the emerging brands, and they too needed a farm system to get the businesses to the stage where the Cattertons of the world could invest. So as crazy as it sounded, I said, why not me? And this July will mark 25 years as industry partner and investor in some awesome emerging brands. So that's how we got here. I jokingly refer to what we do as industry help that comes with a bucket of cash, because there's plenty of money, even though it's hard sometimes for emerging brands to find it. There's not as much help that really gets the emerging brand space. small emerging brands are nonlinear, happens. I mean, it's clunky, and it's an awesome world if you like it, and it's miserable if you don't like it.
It can be brutal. So at the time, so at the what year? I guess 25. So what?
2001.
2001. So at what was the landscape from a investor perspective like at that time? Like, I was there. I mean, you gave a little bit of a preview, but I like.
There wasn't a landscape. I know it sounds weird because you think today about all of the investors that are doing sort of CPG investing, and there were the three I mentioned, and a bunch of others that were doing, 15 to $50 million CPG checks. A lot of them were majority, some of them were minority growth equity, but as opposed to restaurants or hospitality or consumer electronics or traditional tech, where there's tons of people writing $2 and $5 million checks. There literally wasn't in CPG. And I know that sounds weird, but there was nothing between individual pass the hat angels and the low end of the great funds. So when we started this in 2001, we were literally the only institutional investor focused on this space. And it was a good 8 years before anybody else came. Um, and and now it's terrific. There's a great ecosystem. We don't view the other sort of CPG investors as competitors. We're much more likely to be collaborators. Um, but that's typical of growth capital and not sort of more traditional private equity. I'm sure we can talk about that.
So tell me a little bit. So if you were like basically like the only one at the time, like how did you go about like raising that fund?
Well, we started as independent sponsor. Back then, we called it fundless sponsor. The marketers got to it, and it's a much better name as independent sponsor versus the fundless name. Um, and we were fortunate to do a bunch of really exciting, really interesting investments. Our first of which was actually in partnership with Catterton, where we invested in the wellness pet food business. I know this is going to sound crazy to believe, but the whole natural and better for you food space for people was crazy, infantile, small, emerging. So if you had a Venn diagram of a small number of people that were really focused on that and a small number of people that viewed their pet as a child, the intersection of those might be natural food for Fido. Um, and we were lucky enough to partner into a terrific emerging brand called Wellness, um, which now is well over $1 billion. And it was a terrific uh, investment from a return perspective and just a great building of a great brand.
Who ended up buying? Did somebody end up buying it?
Yeah, a family office called Berwind bought it. It's a very interesting collection of businesses, including, if I remember right, Elmer's Glue and a whole bunch of other sort of interesting consumer brands. Um, and then subsequently, that they being a family office, were in no rush, but they did sell it to somebody that has taken it from, I don't know, close to $1 billion to over $1 billion, or whatever the exact numbers are. But it's a monster business. It was one of the first in true better for you. The chicken was actually chicken, not beaks and feathers kind of product.
And so like was that kind of what? So like obviously like today like there's sort of like the GLP-1 better like the better for you. I guess I would say the better for you is still kind of the main thing. I guess it. Tell me a little bit about like what was the seemingly obvious category like when you guys started if there was like no other investors like was there couldn't have been as many brands I guess but was there sort of like consensus.
Yeah, I mean, um, there were life stage events. The most notable one is having kids. But some of it is you get into a relationship or marry somebody that has more of a focus on this than maybe you did. There are a couple major life stage events that trigger moves to better for you or organic. I mean, this may be saying the obvious, but some of these products are not cheap. So there's definitely a correlation between some income and, organic purchase. But if you had to choose between a $200,000 a year income, little education, blue collar worker, plumber, roofer, something, and a $35,000 or $50,000 a year double degree teacher, the teacher is much more likely to be the organic consumer, even though they can't really afford it the same way others could. So education is a much higher predictor of a number of better for you categories than income, although they are somewhat correlated, of course. Yeah. So, I hate the overuse of the Wayne Gretzky, skating to where the puck is going, not where it is. There was some of that, to be perfectly candid. And the idea of better for you pet food in 2002 and 3 and 4, seemed a little out there to some
That's
people.
kind of what I'm saying. Like, it's funny because like even today, like today, that would be like late
Obvious.
almost.
Right.
Yeah, yeah. But like, it's just funny that that's how long the shift, I guess, takes. It's been 20 years essentially, and it's still happening.
Yeah, although that business got really quick, really big, really quick because it resonated.
Yeah, it's so Clear Lake owns it now.
Yeah, it's very obvious with hindsight as a judge, right?
Yeah, yeah,
And there are some of those, it's very obvious to most people with hindsight as a judge that better for you personal care was going to get big after people were so focused on what they eat. They get focused on what they put on their body, not in their body. So it was logical, but it emerged later. I mean, you sort of asked a question of, and you didn't use the phrase white space, but there's still a ton of white space in food and beverage. Not like there was 20 years ago, but there's still plenty. And, the personal care space. There's plenty of white space there as well. Not like there was 5 or 10 years ago, but there's still tons of white space. And there's examples of spaces that are still pretty virgin. We had the privilege of being involved in a better for you OTC business called Wonder Belly. Um, and that's still largely a virgin territory. So, you know, um, there's lots of white space, some places more than others.
right. Which Wonder Belly just got bought by Procter and Gamble, which I think everybody knows at this point. So that was pretty cool to see. P&G kind of come back to the table, especially kind of amidst all this other activity. But maybe that's like a good segue in terms of skating to where the puck is going. Tell us like a little bit about Loft. Where are you guys playing in terms of stage, check size? Where are you looking to invest? Like, what gets you excited?
Yeah. So a quick caveat, over our history, we have done nothing but emerging CPG, and we don't do alcohol, we don't do CBD, and we don't do durables. So it's things like food and beverage, personal care, home care, pet care, stuff like that. With that said, over our history, we've done more and less of different categories over time. Um, at one point, it was probably half to two-thirds food and beverage. Now it's half to two-thirds not food and beverage, although food and beverage is still very interesting and very important to us. But, you've seen this happen live where over the last 10 years, the multinationals in all the categories bought very small businesses, probably too small. Um, and then especially in food and beverage, they've retrenched back to that sort of magic $100 million mark, where there are lots of exceptions, Fatty from a year or two ago and some others. But as a broad overstatement, you now still have to be back to 100 or 200 million in revenue. That isn't the case in all categories, especially in things like personal care and beauty, where the margins are so high. You can have a $10 million EBITDA business and still be a relatively small company, but you can't really in food. A broad overstatement.
Generally, I would agree.
So, So that said, over time, as the food and beverage destination where you have to get to be meaningful to either private equity or strategics has gotten bigger, it makes it hard to invest in a $2 or a $5 million company. Where if they were going to buy a business at 25, it's not as hard. The runway from 5 to 25 is very different from the runway from 5 to 150.
So you're saying basically the floor has gone up.
The floor has gone up, or basically the way to think about it for us is if we were doing this, we're more doing the top half of what we've always done, not the bottom.
So like I'll make this up, but like you're not doing like 500K like pre-seed checks. It's more like couple $1 million seed rounds. Is that like
Yeah.
kind of
Now,
the
in fairness, we never did a $500,000 pre-seed. We're always focused, and this is not a real word, but it's a representative term we call provenness. We know it's not a word, but I don't want to argue over what constitutes a business being proven, because everybody's vantage, P&G's view of what's proven is very different from, what Catterton's view of proven is, which is different than mine, which is often different from a, startup founder. So let's not worry about that. Are you on the glide path?
Yeah, like is it working?
Yeah. Bob Burke uses the phrase reason to believe. Everybody needs a reason to believe, and you need that reason to believe. And the reason on a pre-revenue business is a very different reason to believe than if you're 50 or 100 million.
And tell us really briefly about your partners and kind of where they came from and how you guys all fit together.
Yeah. So, we're a small team in the grand scheme of the world. We're all operators, slightly different perspectives. One that has a deep manufacturing background as well as having run CPG businesses, one that comes from much more of an innovation background, with, having run a lot of businesses, one that's more of a financial, but all are operators at heart.
Okay, cool. So now that we've sort of established, all of that and kind of like where you guys are sitting, I think like one of the core ideas here is let's and like I like this idea of like provenness. Like let's talk about if I'm a founder of a brand and I believe that there's some level of provenness and I'm early stage, but I'm considering like raising capital. And I meet Andy and Loft Growth. Like walk us through like a little bit about like what has to be true in order for the business to like be ready for capital. What should the founders kind of be thinking about in terms of like, do I raise money? Do I not raise money? Like when brand A comes to you and brand B comes to you and you say, hey, brand B, is a good capital candidate. What's true about brand B that isn't true about brand A?
Well, let me take a quarter of a step back and say, despite what I do for a living, too many people are taking too much money, raising too much money too early. The only thing I can be 100% guaranteed about is everybody I know in this space has made mistakes. They look back and said, we made mistakes. Very sophisticated serial CPG operators that have been in the space multiple times with multiple businesses still make mistakes on their third business. And if you raise too much money, you make expensive mistakes. If you don't have a lot of money, you make cheap mistakes. And I would rather you make cheap mistakes. At such time as you're sort of done with most of your early stage mistakes that, again, with hindsight as a judge, you may say was obvious, or it may say, oops, I blew that one. It wasn't obvious. In either case, getting those mistakes out of the way before you blow through 2 or 3 or 5 or 10 that you raise would be my strong preference. The other thing that I'd say, and I say this delicately, is don't raise money because all the cool kids are. Raise money because it makes sense for you as an entrepreneur and for you as a business. And let me take a quick diversion. I have had the chance to meet 50 or 100 businesses that I look at and say, these are awesome businesses. They will probably, and I've been wrong, but probably never get to 50 million in revenue. but they're awesome businesses. You know, there was a personal care business that I met when they were $5 million in revenue, and I think only 2 or 3 people. And, I think they made like a million or two of EBITDA, and then they were 10 million and they were making 3 million of EBITDA. And I was, I'm not perfect, but I never thought this business would get to 50. And my question was, why would you raise capital? This business can be 25 million for sure, and it's going to throw off 10 million of EBITDA because it's so profitable on the gross margin line. And I don't know all the details, but they raised a ton of capital and they never got to 50. Um, so I don't use that example to say I'm all knowing, because I've been wrong plenty of times and I will be again. But I do encourage people to raise capital for the right reason, not because
So
everybody.
what are the right reasons?
The right reasons are you've thought about the end point and the destination. And the way to get to the destination includes raising capital. There are plenty of people that haven't really figured out their destination. And if your destination is, I love this, I never thought it would get to 5 or 10 million in revenue, I am absolutely wowed by that. And if it gets to 20 and I can throw off $1 million a year of personal cash, that's an awesome thing. That's a very different destination from I want to build a business and take 50 out of it. By the way, the former of I build a business and it throws off $1 million of cash is not illogical. And I won't say it happens all the time, but it's not an uncommon occurrence. The situation that gets an entrepreneur to 25 or 50 million at exit is very rare.
Right. Extremely. I mean, it's probably a worse way to try to make a lot of money.
It's certainly a lower odds of success. It's a little bit of the inside straight if you're a poker player, which I'm not. I'm terrible. Anything that involves betting, I'm not good at. But really, I mean, it is a high degree of difficulty dive to raise to build a big business. I mean, everybody talks about, if we were doing this 20 years ago, everybody would be talking about Burt's Bees and Vitamin Water and a few other businesses that sold for $1 billion. Now everybody's talking about, Poppy and, a bunch of others that have sold for $500 million or $1 billion or $2 billion. And, those are the aberrations. There aren't 10 or 20 of those a year.
So I guess I'll put the words in your mouth. Market size, is that kind of like the right proxy? Like I'm looking for like something like quantitative so that I can look at my business and say yes or no. Can I raise capital?
Well, for the people that have a very logical $100,000 first year, $500,000 second year, million and a quarter third year, you're still barely at the precipice to project, draw the line to how it gets to 50, let alone how it gets to 25 or 200 of rev. Um, so I think you got to have enough experience and enough dots that you can draw a line through and see how it works. Um, so the idea of having confidence that you're going to get to 100 million in revenue when you're sub 10, there's just not enough data points in most cases. Now, it's almost impossible to do that if your category size is 200 million. It's hard to build a $100 million category, but I mean, a business. But that said, sometimes the category doesn't know it needs a radical innovation. But again, the vast majority of the businesses that have come out are a better mousetrap of something that exists. It's a cleaner ingredient, modern branding version of Tums.
XYZ, yeah, exactly. Yeah. I bet any of them. Yeah.
So, I mean, it's not rocket science, but it was brilliantly done. And I wasn't the entrepreneur. Two brothers, brilliant, good for them. It was fantastic. It was a product that was needed and a modern branding that was relevant to the times. You look at a lot of these businesses. I mean, something's a soda, or something's a tortilla chip, or, something's a lip balm. I mean, it's not like, they cured cancer, but they're great businesses with great consumer followings.
And are so okay, so we'll say, maybe we can boil it down to, like, market size and, like, proof points in a way that kind of let you extrapolate in, like, a reasonable fashion that this is going to be some level of basically revenue, I suppose. Um,
Yeah, I mean, you asked, how do I know? And I sort of went off on a tangent of don't do it for the wrong reasons. But, if you think about this provenness phrase, in the old days when it was really all about retail, that boiled down to one simple metric, which was some version of velocity, units per store per week, dollars per TDP, whatever your metric is, it's some version of sell through rate. In an e-commerce world, it's trial and repeat, it's, average order value, it's ability to do this without spending, you know, so that you're not profitable till your fourth order. I mean, there's a lot of very simple metrics. And, when I see businesses that are in 10,000 doors and the business is 5 million in revenue, I look at it and say they're about to be out of business, because I don't need to do any math to say they're selling nothing per door per week per SKU, and they're about to get delisted in a lot of cases. I would rather have 100 doors that you're, kicking out and taking names. So don't expand before you're ready. And it's really hard as an entrepreneur. You've been there. It's really hard to say no when Whole Foods come calling and wants to take you national and you're not ready, or, Walmart shows up, or Costco shows up, or, it's nice to be loved, uh, but it's hard.
how do you brought up something which I think is interesting, which is kind of just like this idea of like retail versus e-commerce. Obviously, end state sort of omni-channel is important, but at the stage in which like you are evaluating, I find it like I do some angel investing, and I find it very very difficult to evaluate early stage businesses in retail like only. But I'm curious, something comes across your desk like it's earlier stage, like how are you looking at it from like a channel mix perspective, if that matters to you guys?
Yeah, I mean, well, let's address the example you gave of it's a teeny little business and it's only in a few retail customers. If they're retail customers that are scanner data based, um, an individual angel probably doesn't have access to the scanner data. But if I'm going to write a check, I'm going to go buy the data. And it's a very awkward situation for an entrepreneur for me to know more about their sell through than them. So I encourage entrepreneurs to buy the data. And by the way, most people don't understand it's only a couple $1,000s to go get a one time snapshot. You don't have to have a permanent. You can do that. Both Nielsen and Spins will do that. It's Excel based. It's not like a online subscription, and you can get, these customers, these SKUs, these competitors, whatever you need. But you need that to run your business as an entrepreneur. If you launch 5 SKUs and you think these two are going to be, 25% each, and these three are going to be 20% each, or 20, 20, and 10 to make my math work, and you turn out you're 60% one, 30% another, and you don't know that for 6 months until UNFI or KE backs up, you got a crap load of inventory problems and you got stuff going. So you need it to run your business, not to raise capital. But, having it, there are a ton of resources on the Loft Growth Partners site. There's a section called resources, as simple as that sounds. There's one called the money chart. There are lots of businesses that can show an example of we're teeny and irrelevant in the grand scheme of life, in the grand scheme of a big category or big competitors. But look at what we're selling. We're in 10% ACV, we're in 5% ACV, we're in 100 doors. And look at how we're selling by comparison with somebody that matters on a per door basis or something. That's
Yeah,
a
this is
reason to
I
believe.
like this. Yeah, I like this.
And by the way, there's 100 other ways that you can show the data. because very few people will be lucky enough to have a situation that looks just like that chart. Um, but anything you can do to give people, again, we're back to the reason to believe. Um, so you asked, how do you get there? Actually, if you have scanner based customers, a lot of better for you businesses will start at a Whole Foods or a Wegmans or an HEB or a Meijer. The HEB is the only one of that list that is not a scanner customer. All the others are. So again, most individual investors won't have access to the scanner data, but they could, and certainly an institutional investor will. Um, so it's not as complicated to separate some of the wheat from the chaff, although it takes a lot of work.
And from like an underwriting perspective, then is that like the walk me a little bit through, what matters to you guys? So like obviously like some traction, velocities, like what else do you guys look at when you're like evaluating an opportunity? What should founders know that investors are thinking about?
Yeah, I mean, if I have to boil the world down, and I'm talking specifically about your example of a retail based business, in that situation, there's only two metrics that really matter, in my opinion: gross margins, or if you have a lot of e-commerce, then it's contribution margin, but some metric around not EBITDA, but some margin metric in the middle of the P&L, fully loaded, not sort of playing games with where your trade spending is. Why does that matter, by the way? Gross margin or contribution margin, depending on, in many businesses, the only difference is freight out and broker commissions. But what that tells you is what's left to A, build your brand, and B, build your team. And that's sort of the future of, so gross margin or contribution margin is probably the single most predictive measure of long-term CPG success.
Even at the earliest stage.
Yeah, super early stage.
Interesting. But if I'm early stage, I can expect meaningful margin expansion over time just with scale.
Um, I will apologize in advance, but I don't agree.
Okay.
Scale doesn't matter. Hard work gets you there. So there was a beverage entrepreneur that had gross margins below 25. And that almost is a shut down your business kind of margin structure. And he told me about how he was going to get to 55. And I very politely stepped on the bullshit button. I just didn't believe it. And all of his answers of how you get there were about scale. And I said to him very politely, and we've become really good friends over the years, I said, don't do it for me, but go figure out line item by line item, how do you get from 25 to 55? At what volume, and this happened to be a beverage in a can, at what volume do you get a penny a can savings? Or what volume do you get, half a penny per pound of sweetener? And what volume do you get this? And, how can you do that? And he came back to me in just a couple months and said, I never get into the 30s. And I said, well, what are you going to do about it? And he was scratching his head. And I said, do the exercise backwards. What decisions would you have to make to get to 50, knowing one of them is certainly raise price? And you're probably not going to do that, but what would you have to do to get to 50? And maybe you get halfway there. And I didn't talk to him for 9 or 12 months. And when I saw him maybe at Expo or something, he was giddy. He said, we did the exercise and we found half a dozen really simple, easy things. By the way, my favorite one, and I mentioned this to him, is most entrepreneurs don't know how many colors are on their package in the design. I asked him, how many colors do you have on his package? And he said, no idea. And it turned out the answer was like 6 or 7, which, by the way, in an aluminum can, which has terrible quality printing, or at least it did back then, is total waste of money.
How much would that cost?
A good rule of thumb, and this rule of thumb is 5 or so years, but 4-color printing is sort of normal. 5 colors, not abnormal. Color 6 will cost you double 1 through 5, and 7 will cost you double 1 through 6. Crude rule of thumb.
On just like generally like any packaging?
Almost any package.
Really?
Yeah, really. And most entrepreneurs have no idea how many colors. And if you don't give your designers parameters, um, it could turn out to be 6, 7, 8 colors. And by the way, there are rational reasons why it should be, but in today's world, you can do a lot of gorgeous stuff in 4 and maybe 5 colors.
Yeah, it looks like Wonder Belly's got like basically like one, two, three, four, five at the most.
Yeah, and sometimes shadings, percentage of, red combined with, percentage of this mixes to something, so it may be less colors than you think. But this is one of the questions I ask a lot of entrepreneurs, and most of them don't know. And he saved $1 million a year by going from, I think it was 7 colors to 3. Now, remember, an aluminum can is a crappy print. So having lots of extra colors doesn't get you a lot. So that was $1 million a year. And as the volume grew, it turned into $10 million because the business got really big eventually. But anyway, so he came back and said, this is what I have to do. He found a whole bunch of easy to do things and then a bunch of things that were hard, like he fired his second largest SKU because they had no prospect of ever having gross margins over 5 on that SKU. And that was a really hard decision because it was their
So
second
what did he
largest.
end up doing?
He ended up making a bunch of hard decisions. He ended up doing some formulation work. He ended up changing co-packers, but it was like massive focus of the whole company for 9 months. And when I ran into him, he said, on a reported actual basis, we've got 2 months in the 40s. And I was like, good for you.
Yeah, it's solid.
Yeah. So it's awesome. So the path to gross margin improvement is not usually pure scale. It's usually real hard work. Now, certainly, you can negotiate better deals with higher volume. But again, that requires work. It just doesn't, nobody calls you and say, hey, I woke up this morning and you're doing more business with me, so I'm going to give you a better rate.
Yeah, yeah. Okay. Okay, that makes sense.
So again, in a retail driven business, the only 2 metrics that I really think matter in the very early stage are gross/contribution margin and some velocity metric.
And I think like so when you pair that with like TAM or like market size, like essentially like what you're doing from like a proxy perspective is underwriting some level of like cash flow at scale, right? Because like if we're and this is more for the audience, it's like if we're turning a certain amount of inventory, generating a certain margin, and we can reasonably, like you said earlier, connect the dots to a certain scale, that's where you can say, hey, this business could definitely do 10 million of EBITDA. If I'm in here at a $15 million valuation and they're at 10, we get to 100 plus in valuation and I make my money and everybody's happy and we're all rich. So
Yeah, I think that's right. The one thing that's really important to recognize for the entrepreneur community is P&Ls do not matter. Yes, you need to have them to show investors, and yes, you need them for your bank, and lots of other things. But cash is what really matters. And the difference between P&L and cash is massive in the early stages. Just a couple examples. You pay for your trade show a year before you go. Well, that cash has gone out the door. You can't produce 12 cases of something at a co-packer. So now you're producing, 12 pallets, and that just costs you $100,000. Where if you did the math on what your volume is times your gross margins, maybe it was $5,000. And that $95,000 delta in this crudely hypothetical example and 100 others put people out of business, because the vast majority of businesses that fail, excuse me, do not fail because they're bad ideas. They fail because they run out of cash. And the biggest differential on cash is working capital. People radically underestimate that.
you in the earliest days you may not have a choice, honestly, but like is that like a good use case for equity capital then?
The truth is, in the early days, you don't have another choice.
Yeah. Yeah.
Because you can't get a lot of debt financing or revolver. There's some awesome tools that are quite expensive, but very flexible, whether it's Shopify Capital or anything else. They're very expensive on a percentage basis, but unbelievably flexible with no covenants. That's worth a lot.
That's what I'm saying. I always get in this argument with people where like especially on like Twitter, where like people will like complain about like, Shopify Capital, Wayfly or whatever. And I'm like, you literally have a business doing 500K in sales that's like 9 months old, and somebody's giving you $1 million in like two
Right.
days. It's gonna cost money. Like
And there's no covenants, no reporting requirements, no administrative hassle.
basically it's not even secured.
Right. Yeah. No, I'm with you. So, so the answer of what it takes from a metric standpoint on the retail side, we've covered. We talked a little bit about if you're a D2C business, if you're a little further along to have 5 or 10 million in revenue, I think you just need, and this applies even if you're 500,000 or 1 million of revenue, you need to be able to sort of share with folks that what you're doing is working and it's going to get you to the promised land. Now, yeah, I understand that you're relatively, I mean, even a 10 or $20 million business is pretty early in its life. There's a ton of they're going to dream up that they haven't even thought of, sold to customers they don't even know who they are. But if your plan is based on stuff you don't know what it is, sold to people you don't know who they are, that's hard. If your plan is, hey, we can get to the promised land like this with our core business of what we're doing today. And oh, by the way, we think there's an opportunity for X and Y and Z, which will take us here. And you have two lines, here's the base case, here's the dotted line. If we were to do X and Y and Z, that's much more believable than you peel back the onion and the SKUs you're in the channels you're in is only 20% of the next 5-year growth. So again, it's all about reason to believe and how you get there.
Okay. So then let's take this is great because I like the linearity of this conversation. So um we we only have 10 more minutes. So where we have to go with all of this then is so okay, so obviously like I'm covering a lot of M&A sort of really I mean a lot of other stuff, but it's been there M&A's kind of been crazy lately, and you guys were obviously kind of part of the Wonderbelly cap table, and so I think you'll have like an interesting perspective on this market and how it exists today. What is like your overarching take on the M&A market, either private, strategic, the whole thing? I want to hear the latest from you guys.
Um, I think the dynamics have changed from where they were 5 years ago. And by the way, those dynamics are different from where they were 5 years before that.
Say, tell me how they changed.
All right. And by the way, the dynamics today are much more similar than the dynamics 15, 10 years ago. So how have they changed? There were a couple dynamic changes. First of all, there was a ton of money that flooded into emerging CPG brands, whether it was a $2 or a $5 million brand or a 25 or a $50 million brand. But especially at the sub $10 million stage, there was a ton of money flooding in from outside the sort of traditional CPG investor world, predominantly in tech. And we should come back and talk about that, but
I was gonna say this is a big yeah.
we'll come back and talk about that. But largely that money has gone away from this sector.
Got burned.
Yeah. And we'll talk about that. But the folks like us, like Catterton, like VMG, like Prelude, they were here before and they're here after, and nothing's changed. In between, there was this huge amount of new capital into the space that went away. So that was number one. Number two is the big strategics, and we talked a smidgen about this before, started buying really small businesses. I was at Kraft, biggest food company in the US. We never looked at stuff that was 25 million in revenue because it would get lost in our system, and all the reasons that seem kind of obvious, that almost every multinational passed on their history of it needs to be at least X. And
Why do you think that happened?
I think they were partially enamored with the emerging space. I think part of it was the emerging space was eating their lunch in a lot of categories, so they felt like they needed to do it earlier versus wait a bit. Um, I think they had so much cash, um, they didn't know what to do with it. I think they convinced themselves in some cases, hey, we'll leave it separate or we can integrate it with tremendous synergies. And the businesses had such small consumer followings. I mean, I live in a world where a business I participated in that got to 300 plus million of revenue still had less than 1% brand awareness. Let's think about that. Nobody in the grand scheme of the world has ever heard of that $300 million business. Um, and that's just hard for a multinational or even a medium-sized strategic to deal with such a small business. Gary Rodkin, when he was running ConAgra, had a perspective, and I think this was very savvy. If I can't add half a point of growth with an acquisition, it's too small. So when ConAgra was much, much smaller, a $40 million revenue business was half a point of growth, and that was fine. As he got bigger, $40 million wasn't anything that mattered because ConAgra got much bigger. So I think those were the two primary drivers. As a result of those two drivers, all this money from outside the space and strategics dipping down, entrepreneurs were raising a ton more capital than they ever had been before because there was so much.
And when is this? This is like the 21 era.
Even 2018 or 2019 through 22 or 23. Raising too much money too early, just assuming that they could just raise, growth mattered, profitability didn't. I was at a panel discussion with Naturally Boulder, and somebody not realizing I was in the back of the room said, there's this guy, Andy Whitman, that's been talking about the importance of profitability or the potential for
What a
profitability for a
contrarian.
long time. And his comment was, it seems like the rest of us just figured it out. No, but there were some people that entered the space during the days where nobody was talking about profitability. So for a lot of reasons, there was just so much money, valuations got pushed up, returns didn't develop. When you had bumps, I mean, COVID was a big bump, but when you had stuff like UNFI hack, which destroyed some businesses for 30 days or 90 days.
Oh yeah, remember that?
Yeah, I mean, when those things happens. That's life. That's part of this industry. I mean, I remember being a young kid at General Foods when somebody was running a test market and the truck got in an accident going to the test market and it destroyed all the product.
We had a Mad Rabbit. We had a truck. I think it like flipped over.
Yeah, I mean, it happens. And, people that aren't from the space, it's like, well, why didn't you have it on two trucks? Because it was only two pallets. I mean, anyway, so that answers the question of the biggest reasons why the dynamics have changed. And quite frankly, the dynamics of, the multinationals or even medium-sized strategics buying things that fit their scale and system makes sense. Now, I had some smaller businesses purchased and I wasn't upset at it, but I never thought some of those made sense from the strategic's perspective.
And so where are we headed now?
I think, you talk about this wave of M&A. There isn't a wave of $25 and $50 million businesses being bought. There are a few exceptions. So my take, and Nate on my team deserves a lot of credit. He helped to do some data work and crystallize some of the thinking. But part of what we've talked about as a team is there's huge bifurcation. I use the phrase asterisks. A business that has a whole bunch of asterisks, they lost a customer, gross margins dipped 10 points because of, doesn't matter what it is, some asterisk. Businesses that have a whole bunch of asterisks are a problem. Businesses that are high quality, meaning they don't have a lot of asterisks, that are sort of winning, interesting margins, high growth, hopefully making money, or at least the belief that you're going to be doing it, haven't overbuilt infrastructure, aren't spending money like drunken sailors. Those businesses without many meaningful complexities are being acquired at big prices. Now, again, they probably still have to be 100 or 200 or more of rev. Um, but the ones that check boxes and are uniquely brilliant fits, as opposed to you're trying to talk to somebody into buying a business, um, a company that's in the beauty business that has X and Y and Z, but missing this hole in their portfolio, or I had the privilege to be involved in Mega Food, which was acquired by Pharmavite, sort of the monster 800-pound gorilla in vitamins, but they didn't play in the top of the pyramid of whole food based, naturally derived vitamins. They played in the medium part of the pyramid and the bottom. So it was a uniquely good fit. And you see, most of the acquisitions are uniquely good fits. And by the way, it only might be a uniquely good fit to two people.
And I totally agree, and I think people tend to get this wrong because, like, and I don't know that I do a good job of like, I may be propagating this a little bit from the standpoint of, like, okay, like, brand XYZ gets bought for 10x EBITDA, they're doing 70 million of EBITDA, it's a big transaction, and entrepreneurs tend to think, okay, all I have to do is get to 70 million of EBITDA and then I get bought for $700 million. And to your point, it's like there are so many other like sort of intangible things that have to be true for that. Like you don't just get to sell your business just because your number hit XYZ. Like there has to be some real reason that honestly isn't financial. Financial is just how we arrive at the valuation.
That said, I know it was just a random example you picked, but any business with 70 million of EBITDA will always have a buyer. The question,
Of course, but private equity.
yeah, but you can always sell a business with 10 million, forget about 70 million. You can always sell a business that isn't in hemorrhaging decline. Any business that's stable or growing with 10 million of EBITDA, you can always sell for 7 or 8 times EBITDA, probably 10. um, because it's a real business. It's the ones that are a million or two or three of revenue, of EBITDA, that you can't put enough debt on if you're a financial buyer. And if you're strategic, the revenue is likely to be too small to matter. So, um, so let's look at the other side, which is, so you get the ones without a lot of asterisks that are great fits, blah, blah, blah. And there's been a rash of those. And I think some of them are just an accumulation of ones that just took a lot longer to get done and probably should have happened in the fourth quarter. So there's a combination of the ones that should have happened in the first quarter plus the ones that should have happened in the fourth quarter that are all happening at once. So I think there's a little bit more of um, an optics than reality. But what about the ones that don't fit that profile? Well, unfortunately, and this is not something either the investors or the entrepreneurs want to think about, but most of those don't have a strategic exit, and they may not even have a financial buyer exit. They may be what's sometimes referred to as a highly structured exit. It's a combination with another brand, and maybe it's an all equity deal. Maybe there's a smidgen of cash. Um, Maybe it's you put the two businesses together with a hope that it turns into something on the equity side, but it's not a meaningful cash exit. And the businesses with a lot of asterisks, or not growing, or not profitable, or some combination of these, tend to, unfortunately, so the bifurcation between the first group we talked about and the second group, that chasm is like a Grand Canyon.
Yeah. All right, Andy, we got just a couple more minutes here left. As we wrap up, I think one question that I like to ask investors, just because like now that I'm on like the other side of things, I probably get to see quite a bit as well. But you guys see more than anybody. I'm sure you guys talk to like thousands of companies a year. Like, if you were going to start a brand tomorrow, what category and product would it be?
Well, I mean, that's a hard question, but it's more likely to be in some of the categories with lesser better for you entries like home care or OTC or some aspects of personal care and beauty than it is to be other aspects of personal care and beauty or food and beverage. Again, you're asking a very hypothetical general question, so it's sort of a general answer. But
It's supposed to be fun.
yeah, absolutely. There's less competition in some aspects of like OTC or home care than there are in you know, most beverage categories, for example. Um, that said, there's plenty of amazing differentiated products in classic food and beverage. They're just, it's a little harder. Margin, in beauty and personal care, you're doing something really wrong if you don't have gross margins that start with a 5, and they probably start with a 6 or maybe a 7. You don't see that in food and beverage.
All right, Andy. Well, tell the audience where they can find you, how we can get in touch with you, your
Yeah.
website. This time is yours to kind of give them the ability to
Yeah.
reach out.
I don't need to do an ad. If people want to reach out, it's Andy at loftgrowthpartners.com and our website, loftgrowthpartners.com. And again, check out the resource section. There is a ton of free resources there.
There's good stuff. There's good stuff on here. I'm scrolling through it. It's actually pretty good.
Yeah, it's really valuable. Some of it's a bit old, but there's still great content there. And the two things that I would point out to people that are actively raising capital, not necessarily past the hat angel money, but there's a list of all the angel groups in the country, which ones have invested in CPG, which ones say they want to do it again. We did that for the first time 10 or 12 or 14 years ago, and we've updated every 2 to 3 years. It probably needs another update, but it's at least all in one place.
You should post this. Yeah, this is a big list.
It's there. And then um, I don't get a chance, Gary Hirschberg, who's the founder of Stonyfield, um, made a comment probably 20 years ago referring to me as an entrepreneur. I never thought about it that way, but I guess, I started a business in a space that had never had a fund, and I've sort of embraced that over the years. As you know, entrepreneurs don't truly shut down very often. And I guess about 14, 15 months ago, I was on vacation with my daughter and really did shut down. And 4 or 5 days into it, I woke up with a sort of realization of, even though we're one of the earliest stage institutional investors, we're still meeting tons and tons of people that are too early for us. Where do they go? So I reached out to a whole bunch of friends, and there is a list, all with their permission, of people that write $250,000 to $2.5 million checks in branded CPG, and it says what their criteria are and contact information. So I'd point people there as well, and some other things like focus on cash. There's a cash is king workshop and some other things. But
Yeah,
anyway,
this is good stuff. You guys should post this on like LinkedIn if you haven't.
we probably don't do enough about it, but we should. And by the way, before we wrap up, the ecosystem needs to thank you. A bunch of the stuff you're doing of sharing information is great for the ecosystem. So there are a bunch of us that are doing sort of stuff out there to help the ecosystem. I do a ton of workshops on how to finance your growth. I don't get anything out of those economically, but I love doing it, and it's transformational for a lot of these entrepreneurs. As a matter of fact, there's one coming up in San Francisco the second week in May.
Oh, nice. Okay. Yeah. Yeah, that's great. And I appreciate that. So, Andy, thank you for coming on the program, sharing some words of wisdom. You
My
know where to reach
pleasure.
Andy if you wanna chat with him. So, yeah, it was great to see you, and hope to talk again soon.
Take care. Thanks all.